I want to talk to you today about several things, and I'm going to end today with a daring prediction. Of course, a lot of people will comment below and they will say, "Oh, Jason, you're out of your mind," or "Jason, you're exactly right." But I just really encourage you to listen to our Flashback Friday episodes, or if you're more interested than that and diving in, just go back and listen to any of the old episodes that I've done over the last 18 years. 18 years, right? Almost 2,000 episodes on this show. And then, of course, I have many other podcast shows as well. But just on this show, 18 years of predictions. And just look at how many of my predictions have come true. And I would say there was one major prediction I've made over the years, and I've kind of stuck to it, but I was pretty wrong about it. And I freely admit that. I've admitted it many times. And that is interest rates. I'm notoriously bad at predicting interest rates, but I'm going to make an interest rate prediction in this episode. And for some of you, it might kind of blow your mind. So we'll get to that. But the other prediction that I was wrong about is during the pandemic, I really predicted pretty bad things for New York City. And the Big Apple has kind of proven me wrong a little bit here. And I don't know, am I really wrong? Well, certainly if you look at the commercial real estate market, the eroding tax base of New York City, the skyrocketing crime rate, that's all bad. But I am really quite surprised that rents in New York City have held up as well as they have. They've gone up. They've gone up. Now, at first, they went way down. A lot of people were leaving the city, and a lot of people have left the city. But still, somehow, residential rents, and I believe from what little I know about it, I'm certainly no expert on it, sales prices holding up pretty darn well on the residential side of New York real estate. So this is a prediction I'm kind of wrong about. I'm just putting it out there. Hey, listen, I have a secure enough ego that when I'm wrong, I can admit when I'm wrong. The interest rates, certainly, I've been pretty bad about predicting those. It's a centrally managed economy, and we never know how the central planners are going to manage things. And by the way, let me clarify my interest rate prediction thing before we get into some of this other stuff I want to share with you today. Back in the, kind of the 2004 to 2008, even to 2010, 2011 time period on this show, just go back and listen to the episodes. I really thought we would have higher interest rates than we did then. I thought there was just a lot of pressure for the Fed to raise rates. I thought mortgage rates would go higher, but, never underestimate the willingness of the central planners to sell out the citizens. And I believe that overall, they're going to continue to do that. And the big trend is going to be inflation. And they are going to, I'll get into it at the end and I'll tell you. I'll tell you what that prediction is here in just a few minutes. So let's just look at some data first. So if you are watching this on video, I've got some good charts and graphs on the screen. So let's talk about the banking crisis. I clip a lot of things from various newsletters I subscribe to. Some are free newsletters, some are paid newsletters. We certainly spend a decent amount of money over here on subscriptions because it's just important to be able to share this data and the insights with you. And so this is from Axios, and it talks about U.S. bank failures by share of total bank assets. You remember back to the Great Recession, the global financial crisis, whatever you want to call it. Of course, the big bank failure, the huge one, was Washington Mutual. And that represented 2.71% of all the US banking assets, almost 3%. Now, the three big failures we've had recently, First Republic, Silicon Valley Bank, and Signature Bank, those all together represent less than WAMU back then. Okay, so just keep things in perspective there. They represent about 2.4% of all the banking assets. Okay, so it's definitely a much, much smaller crisis situation. But nonetheless, these are signals, and the signals are important. And this is why the Fed is in just such an incredibly difficult position. They have painted themselves into a corner. And I believe I know how they're going to get themselves out of it. And for most people, it's going to be bad news. But for you, because you listen to this show and hopefully you're following my plan, it's going to be great news for you. Remember, it's nice to say, it sounds really good when we all say, hey, the pie is big enough to go around. And look, capitalism does increase the size of the pie, much better than certainly communism or socialism. That shrinks the pie in most cases. But even then, the pie is limited at any given time. And some of these new technologies, like the artificial intelligence revolution that's going on, I think that is going to massively increase the size of the pie, which is great news. But the pain point to get there, and by the way, this might be a tangent alert, is a lot of job losses on the way there, right? So the economic pie is a relativistic game. And so as long as you can be ahead of the masses and your slice of the pie is growing or at least staying stable, you are way ahead. I won't bore you with that old sort of meme about the two hikers in the woods and, outrun the bear kind of concept, right? But that's really very true, because that is the answer to the question, compared to what? The compared to what question, right? Okay, so this article goes on to talk about how the Fed was at pains to point out yesterday, quote, the US banking system is sound and resilient, unquote. The chart begins to explain why they might be so sanguine. And again, when you look at these banking assets, and you look at the hold to maturity types of assets that the banks have that we've talked about many times, starting with the Silicon Valley bank crisis a while back, it doesn't tell you enough information, because it doesn't tell you what the maturity date is or what the rate is on those assets that the banks hold. But there is enough of this to concern the Fed, and I believe to put extraordinary pressure on them to pivot, even though Powell is signaling that that's not the case. And at the last meeting, they raised again for the 10th time. I can't believe it. Are they out of their mind? Well, they got an inflation problem on the other end. So they've got to do something about that. They've painted themselves into a corner. And it's really, really a tough situation for the Fed. So this also talks about how the global financial crisis was also much broader and lasted for years. Between the failure of IndyMac in July of 2008 and the demise of National Republic Bank of Chicago in 2014, a whopping 501. Wow. That is monumental. 501 FDIC insured banks failed, collectively comprising more than 6% of total assets in the commercial banking sector. That was big.